Until yesterday, or up until yesterday, the Nasdaq had a very signal. A left-right combo right here at the 50-day moving average, confirming the downtrend. A doji sandwich, which is a big down day, a doji, and another big down day, closing below the T-line, was a good indication that we might be in a pullback. The only reservation was that even though the S&P had the same scenario, the Dow had a strong buy signal, a Morningstar signal right on the T-line. And it traded up today, which brought the rest of the markets up. So this analysis is more to illustrate that if all three indexes, the S&P, the Dow, and the Nasdaq, aren't trading in harmony, then nothing has changed. You still have to be conscious of the fact that the investors are all not bailing out or all not roaring into the market. So the fact that we saw a Morningstar signal in the Dow yesterday when the other two indexes were selling off was a good indication that we still need to see some more confirmation one way or the other. At worst, if you've got one index going up and two going down or vice versa, usually the trend will continue in the direction that it's already been moving in. When markets are trading inconsistently, it's still an advantage to be able to identify candlestick patterns, such as the rounded bottom. Notice how the small indecisive trading stayed just above the T-line, but it was rounding up. This is usually an indication of a good, strong price move to break out, which happened today on our recommendation of a few days ago of ATHN, up a good 9% on the day, right up to the 50-day moving average. Still do not have a sell signal, but we definitely want to see it open positive the next day. The point of this illustration is that if you buy patterns, the probabilities of being in the right place at the right time improve dramatically for one's investing. And candlestick signals allow you to observe the obvious with a much greater accuracy because of the visual aspects of investor sentiment. We shorted lean hogs the other day because notice what was happening. We had shooting stars, which basically common sense tells you that every time the bulls took it up, the bears knocked it back down. This was an indication that things were starting to get weak, plus your stochastic started rolling over. Started shorting in this area because this was confirmation that they weren't going to keep it up above the T-line. We're still short with the anticipation that we're heading for the 200-day moving average. The T-line makes a very simple trade strategy. If you see a candlestick sell signal and a close below the T-line, you stay short until you see a candlestick buy signal and a close back up above the T-line. That'll be it. We'll see you in the chat rooms.